So private investors aren't too worried about extension risk. What about the Federal Reserve?
Well, I mean, they don't care. I mean, they just print the money, man. I mean, they're taking a loss to who? So the price of the bond goes from 105 to 90, and they have in theory a loss. Who cares? I mean, a loss to who? They'll just print the money. I mean, it doesn't make a difference. They'll carry their balance sheet, and they've already said that if we have a loss, we have a special account to put it into to go and book it. But I mean, it doesn't matter.
Right. I don't think they're worried about the loss, but what about the fact that they've assured the market, or they said that they, at this time, are currently not entertaining, it doesn't look like we're going to have to sell mortgage-backed securities. We're going to let them roll off. And they want to do 35 they want to reach a level of rolling off $35 billion of mortgage-backed securities a month. But what if the maturity of those MBSs extend and they won't be allowed to roll, and not as much as rolling off, and they will be forced to either not get to their $35 billion goal, or they will have to sell MBS into the market, which, based on from what I've heard from people in the market, would be a disturbance because you're sort of flooding the market with with issues that the market thought it didn't have to worry about. Is this something that people should be worried about or no?
I don't think so. I mean, I got to go talk to Ira at Bloomberg. He's their bond guy there. He's terrific. I think the actual wording is a maximum of 35, not a target of 35. And so if it got to 40, they would then buy some back to make it 35. I don't think their target is 35. I think that's their maximum limit. So if it comes to 20, I'm not sure they hit the bid for 15. I could have read this thing wrong, but I think that's actually the actual wording was a maximum of 35, not a target of 35. Same thing for treasuries.
You're right. It's called a cap. You're definitely right about that. Yeah.
I don't think they hit the bid. They might if inflation keeps running really hot at 8, they'll go tap the bid. But the problem is if they go call up Goldman or Morgan or Merrill and say bid 5 billion Fannie fours, oh yeah. I mean that'll be a problem, man. I don't think they sell mortgages. I think they're more likely to go and sell treasuries first. They prefer to be out of the mortgage business. They do want to do that, but it would be challenging because you have a much. Well, the mortgage market's huge. It's a smaller base of people. You're not going to have China and Japan and other world central banks buying mortgage bonds as much as they'll buy treasuries for their reserves. I mean, I can assure you that the foreign central banks do own Ginnies, and some Fannies. Guarantee you that. But I think they're going to. I mean, I prefer they go and tap the back end. Truth be told, and they sold 30-year treasuries to steepen the yield curve.
Sell a ton of 30-year treasuries.
Well, my preference is they steepen the yield curve. I think it's a public policy good to steepen the yield curve for a lot of reasons I've written about in the past. Primarily, it strengthens the financial system by, I hate saying it, giving money to banks. I mean, we are a financial economy. We're massively levered. Debt to GDP is a gigantic number. We need the plumbing to work in the system. Should bad guys have gone to jail 10 years ago? Yes. Was a public policy mess that they didn't? Yes. Clearly we had the ability to do it. In '89, we sent lots of guys to prison in the S&L crisis. So we could have gotten Stan O'Neill and his, other bad guys if we wanted to. But we need a strong banking system just to keep the money flowing.
You definitely have been in the inflation camp, which has obviously been right. What if owner equivalent rent is in the double digits and there is an even greater pressure from society, from the government on the Federal Reserve to tighten monetary policy as fast as possible, and the Federal Reserve, they need to get to 35 billion to slow down the housing market?
Possible. I mean, yeah. I'm not going to say no. I think I know what I think they should do. That doesn't mean they're going to do it, and it doesn't mean I'm right either. Like I said, I think they should sell long dated treasuries to go steepen the curve and have the mortgage market hold spread at 100 over. But also if rates go, you're going to see a massive supply collapse in the mortgage market. The refi index is already down by a gazillion. I mean, housing market is gonna stop dead in its tracks real fast. If you consider that the average civilian, okay, non Wall Street gazillionaire, does not buy a house. They sign up for a 30-year stream of payments. Let's say the payments are $2,000 a month. That's what he can afford. He's not getting a big bonus. Okay, his income ain't moving by more than 4 or 5%. He can afford $2,000 a month, and that's it. You go work backwards into the calculation. I wrote about this also a while ago. It's called House of Cards. It's in my archives. Rates down 2 or 3 years ago basically covers about 85% of why housing jumped by like 22%, because rates going from 5.5 to 3.5, lower the payment. So if you up the payment back to your 2,000, you could borrow 20% more money. Well, we're now doing the reverse, and so in theory, with rates at 5.25 as opposed to 3.25, to keep a constant payment, housing's got to be down by 15% to go and do that. Will that happen? I don't know, but if it doesn't happen, then housing is going to stop. People, there's only so much money you have. Okay, there's no free lunch out there. Well, the MMT crowd thinks there is, but away from that, there's no free lunch. So housing part of the economy is going to hit a brick wall real fast.
What does real fast mean? Because I've got an extremely unscientific and non-quantitative observation, which is just that the Case-Shiller does not typically have a blow-off top like a speculative tech stock. If it's shooting up, exploding higher as it is now, first it has to roll over, increase slowly, then flatline, then decline slowly, and then it will finally plummet. But that whole process takes 18 months or 2 years. So when you say really quickly, what are we talking here?
Well, there's housing prices, and you are correct. The housing market is like Wile E. Coyote. Okay, the problem hits, and it keeps running. It takes like a year. If you looked at the '89 downturn, the '08 downturn, both times you saw housing keep on going even after you'd already blown up the bridge. So yes, it'll take a year before prices turn down. But as far as the economy goes, so the people building the houses and the guys selling the lumber and the copper for the pipes and this and that, that's the whole economy, the jobs related to the housing market, that will slow down because demand will slow down, at least demand for used houses. New houses, the demographic is still plowing ahead. So it's going to be interesting how this all plays out. But clearly, you've taken rates up by 2 points, man. The numbers are the numbers. Unless people borrow money from mom and dad, which might happen. There is a massive amount of money with the boomers who will give to the millennials, and maybe that's what happens. But the money is gone. Now you got to go and plug the hole somehow. And you plug the hole by not buying a house, taking money from mom and dad, or lowering the house price. Pick your poison.
Well, Harley, as we approach a close, what would your highest conviction view be at this point? Would it be your thesis that's bullish on mortgage-backed securities, or would it be some other area in macro, in bonds, credit, stocks, or volatility?
I think that mortgages relative to safe assets will do better. That I feel most confident in saying that. Now, by the way, if treasuries go up by 1% in rate, mortgage bonds will also go down, but they'll go down, I think, by their rate will rise by 50 basis points or 40 basis or 60 basis points. They'll move by less. So if you have a portfolio, and in that portfolio you have an amount dedicated to interest rate, called bonds, but rate stuff, and that in that basket is treasury funds or investment grade credit funds or high yield funds, I would sell those, notwithstanding the tax impact, and move into mortgage funds. That would be my most confident prediction. I'm very comfortable that inflation stays high. I'm not comfortable in saying what bonds will do. We could have a negative real rate for quite a while because, truth be told, the Fed likes that. Fed likes a negative real rate. They may not say it, but they like it. The high nominal inflation reduces the amount of debt, reduces the value of the debt, reduces debt to GDP, yet the negative rate encourages the economy because people will borrow money at a negative rate to start a business. So you get both. You get the economy does well because of negative real, but nominal debt to GDP collapses because of inflation. So a negative real rate is their dream scenario.
So you're confident inflation will remain high and that it won't crash down to 2% or even lower anytime soon. But you don't know what bonds are going to do. If bonds continue to rise, the product that you structured probably will continue to do well. If they stay low, which you say is definitely very possible as well, that will be sort of, I think you used the phrase nirvana for risk assets, because the E for earnings at Amazon is increasing, but the P in terms of the price is not. The price isn't going down because the discount rate is staying level, or it's going down as well.
Yep.
Yeah. Okay. And then can you explain you said that, obviously nothing you say is investment advice, but you said that maybe getting out of investment grade and high yield bonds into mortgage-backed securities. Can you explain what the sort of the risk swapping you're doing? Like, why do you want to move away from credit risk and into convexity risk? What risks are you avoiding by making that switch?
Well, I mean, I'm getting rid of default risk, which is nice. If we've got a recession, then you're going to have defaults and credit spreads widening. But also, it's just the relative level. I mean, when you buy a mortgage security, it's just a buy right. You're buying a bond and selling a call on the bond. You're doing a buy right. I mean, vols are very, very high right now. So buying a bond and selling the call on it, just a good idea. You're selling the call at a very inflated price. So that's why I like it. It's just simple, relative value RV, one versus the other. So I kind of like that. The other thing I like also, they've tightened back in a bit, muni bonds. AA or better muni bonds. I mean, in California, you could buy, I bought California muni bonds last month at a 4.1% yield. But a 4% coupon, price of $99. And in my tax bracket, which is not everyone's, but in California, you're 50% pretty quick. So that's an 8% pre-tax yield. 8% yield is getting close to equity returns over time. So, and then if you buy that kind of thing, you then buy my hedge product with it to go and soften up the convexity of it. And the mortgage bonds also. Mortgage bond is selling a rate option. My hedge product is buying a rate option. And there are different parts of the term surface, so you're actually kind of, I won't say locking in a profit, but the option you're buying in my hedge product is probably 30% cheaper than the option you're selling in a mortgage security.
Interesting. My final question for you, Harley, concerns a convexity position that I think you've been very favorably inclined towards for a long time, and that is buying longer duration call options on equity indices, the S&P 500, as well as European equities. And I just think, historically, that's just done very well because we've been in a bull market, and I think call options have kind of been underpriced. Setting that aside, what are your views on those two trades now, given that we're in a pretty severe equity rout in both Europe and S&P 500?
Oh, this is a very complicated question. One of the key value adds in the long-dated call option, in Europe, I was going on 5 years. In the U.S., 2 years, was the borrowing rate, the interest rate where you borrow money. Because when you buy, let's say you buy a call option on $1 million of stock, you're basically borrowing that $1 million from the option seller, like Citadel. They have to go then fund the borrowing of that stock to go and put their hedge on. And they can do it pretty easily. When rates were at 0.25% out for 2 years, then when you bought the call option on the U.S. index, you're borrowing money. You're locking in via the option a borrow for 2 years at 0.25%. Well, now rates are like 2.5, 2.75 on 2-year rates. This trade is not nearly as attractive when you are borrowing at 2.75 than borrowing at 25 cents. In Europe, you are borrowing at negative 0.5. Now rates are positive $1.50. And when you take 200 basis points to the fifth power, I mean that's a huge difference in the value add. And also, vols are a lot higher. I mean,
right.
Buying long dated calls is still not a bad ticket, but it's not nearly as good as it was because vols are higher and front end rates are higher also. So you've really lost a lot of the value for that.